Hi everyone, my name is Yehuda Levy, bringing you another article from our series Come Learn With Me. Today's article will be reading about the institutional investors see Japan as a real estate darling, but have turned cold on China's property market. So let's take a look. Both Japan and China have kept interest rates relatively low, despite US rate increases weakening their currencies. Singapore-based institutional investors have been active in Japan, according to analysis at MSCI Real Estate Conference. Okay. A weaker currency and low interest rates are drawing Asia-Pacific property investors to Japan, although similar factors have not helped China's bruised real estate market, according to analysis attending an online conference by MSCI Real Estate. Both Japan and China have kept interest rates relatively low, despite US rates increases, and both have seen weaker currencies as a result, normally a push factor for cross-border institutional investors. The Bank of Japan has struck to an ultra-loose monetary stance in recent times, with the yen falling at one point to a 30-year low against the US dollar. Meanwhile, China's yuan fell to a 2-year low against the greenback after the People's Bank of China cut interest rates in August to 3.65% from 3.7%. The one market that stands out above all others is it's naturally Japan, with low borrowing costs combined with the yen slumping to a 30-year low, said Ben Cho, head of Asia Pacific Real Estate Research at MSCI. Virtually every client I've spoken to here in Singapore in the past 2 months is targeting the Japanese market. Singapore-based Q Investment Partners (QRP) is one of the institutional investors that have been active in Japan in recent months, with the 40 million US dollar fund raised mainly from investors in Singapore and Hong Kong. The private equity firm acquired 3 multi-family assets in the Japanese city of Osaka and Nagoya. According to Peter Young, QRP CEO, the assets comprise 207 units and have about 90% occupancy as of June. We see a lot of opportunities in Japan. The 40 million US dollar investment is the start, and we anticipate growing that north of 1 million US dollars. Young said in a video interview, our target is to build a portfolio that really focuses on the 4 major cities in Japan of Tokyo, Nagoya, Fukuoka, and Osaka. Property consultancy CBRE also said Japan is currently considered the #1 property market for investors. If we use the CBRE capital markets business in Japan, we have never been bruiser. Bruiser, said Crystal Parlow, managing director for Asia at CBRE. We were busy across asset classes, retail, hotels, office, and industrial. So deals for 50 million US dollars up to some billion deals as well, because the Japanese market offers that positive spread. We expect strong trading conditions to remain going forward. However, analysis said China's $2 trillion US dollars real estate market remains in the doldrums, said MSCI's Cho. China is one market where plenty of assets were up for grabs, but there are few targets, and said Cho. Investors from North America and Europe appear to be staying away for the time being. even as those from Singapore and Hong Kong have been, picking up choice assets amid the sell-off. Only time will tell which strategy will pay off in the long run. James Cameron, head of global commercial real estate at Standard Chartered, said a major reason for investor caution is the worsening residential property crisis in the world's second largest economy. With China at the moment, we're looking through two different lenses. You have the residential market, which is undergoing some material stress and sort of deleveraging and repositioning. And then you have the more traditional asset-backed market, said Cameron. We continue to see people looking at investing in the later, and we do see value. And there are probably more entities in China where people need to see assets. China's property slump came to the fore after Beijing introduced its three red lines in August 2020. It stemmed systematic risk from over-leveraging developers. This led to a liquidity crisis by shutting weak developers out of loan and bond markets with $29 billion of debt defaults since the start of 2021. All right. Thank you for joining me today. If you enjoyed our series, please make sure you like and subscribe. And if you want help with your business, click on the link in the description.